A very warm greetings to all my viewers. Today I'm bringing something different than my usual option-based uh, videos. So I'm going to talk about, in very simple terms, how can one create a momentum based portfolio. If you are an active participant in the stock market, I'm sure you may have heard the term momentum. And in fact, momentum strategies are very popular on platforms like Small Case. But I also see that there are a lot of people who execute or have taken subscription of those strategies without really understanding what goes behind the scene. So this is my attempt over the next 15 to 20 minutes to unravel in very simple steps what does it take to create a momentum strategy of your own and execute it. So let's start uh, without any further delay. So the first thing first, I will start with a very quick background. And now I know it is a bit academic, but it's better to understand the genesis of something that we are going to understand about. So Eugene Fama, who had won the Nobel Prize in economics for his work on efficient market hypothesis, was of course a very very big proponent of this efficient market hypothesis, which essentially says that you cannot beat the market return. Of course, I have written on the slide, you can read more in detail what he said. But the same Eugene Fama in 1996 wrote a paper along with Ken French, where he said that the biggest anomaly to his efficient market hypothesis is momentum. And essentially, what he saw that the stocks with high return over the past 3 to 12 months tend to outperform in the future as well. In fact, later in his career, he went on to say that momentum is the biggest embarrassment to his efficient market hypothesis. So the one, the person who brought in efficient market hypothesis himself admitted about the utility of momentum. So no doubt about uh, the whether it works or not. But who brought this entire research to the fore? And that is the credit for that goes to Narsimhan Jagdish and Sheridan Titman, who wrote a paper in 1993. I have uh, the link on the video. I will also put it in my YouTube description so that you can go and read the original paper. So whatever they wrote, in the context of the Indian markets, how can you implement the same? I'm going to describe in the subsequent slides. So this is a very, very simple four-step process. First, you need to select the stock universe. So if in India, for example, Nifty 50, Nifty 500, etc., I'll describe in detail. You also need to decide on the overall strategy characteristics. And I'll come to that. What are those characteristics? Once you have decided that, then you need to run certain filtering conditions on the stock universe and come out with a set of filtered stock list. What could be those filters? I'm going to describe in the slides subsequently. Once you have the filtered list of stocks from the universe that you want to run your strategy on, then you rank order them. After ranking them, you invest in certain number of stocks that you have decided in equal proportion, and then you periodically at certain interval or certain frequency rebalance that portfolio. Now at the time of rebalance, you can also decide whether you want to pause the portfolio, and I will talk in detail some of the best practices which I've observed based on my own running this strategy for a while, as well as backtesting. So let's move on to each of the steps. So the first step is to decide the securities universe and the overall strategy characteristics. So as I mentioned, this could be running on the stocks or the ETF. Of course, there are dual momentum, which you can run on two different asset classes. I'm not getting into that. For a simplicity's sake, we say in India, you want to run a large cap, you would run on Nifty 100. You want to run on mid and small cap, Nifty mid and small 400, which is 101 to 500. Or you can run on the entire Nifty 500 or Nifty 750. My favorite, because I also do a lot of FNO trading, I run on the FNO universe. There are right now about 229 stocks. And these are large to mid cap stocks, which are there in the futures market. I run my strategy on that, but you can choose any of the other stock universe that I told you. You can also run it on a set of liquid ETFs. So you can decide 50 or 60 ETFs, which are liquid in our country. And you can also create a momentum strategy on ETF. So it's not that you can create it only on the stocks, you can do it on the ETFs as well. So first you need to decide what is the universe you want to run it on. The second thing, which is very important, are you going to create a 10 stock, 15 stock, 20 stock? What kind of number of stocks you are going to have in your portfolio? The common momentum strategies are run with 10 or 20 stocks. Higher the number of stocks, lower the drawdown in many cases. 10 and 20 doesn't matter too much. But if you increase it to 50, then the drawdown goes down. But then 50 comes with its own set of challenges. So I look at about 20 stock portfolio. But if your universe is very small, for example, if you're running on just a 50 stock universe, like Nifty 50 or Nifty Next 50, then 20 becomes too many. You may like to select just 10. But if you're running on the way I run on FNO universe, which is 220 odd stocks, or Nifty 500 or Nifty 750, then I would say you should pick up 20 stock as the number of stocks that would be in your momentum portfolio. So that's the second decision. The third decision is that what would be the rebalance frequency? When do I look at adding stock to my portfolio or exiting certain stocks in my portfolio? And how should I rank them? I will talk more detail on that. But essentially, you rebalance your portfolio once in a week or once in a month or maybe once in a quarter, but weekly or monthly is fairly suitable. There is not too much difference between weekly rebalance or monthly rebalance in most of the cases, but in certain cases that could cause a difference, so that you should be backtesting your strategy to decide what is the optimal rebalance frequency. So that's the third thing that you need to decide. And finally, you need to decide the exit or the pause rules. Is it that you will always be invested, irrespective of the broader market conditions? Or there are situations where you will pause your strategy and you will move to some other asset class. It could be liquid fund, which is cash, it could be gold, or it could be fixed income, it could be anything. But you will move your money out of this momentum portfolio, or you will continue irrespective of the market condition. I will again talk about some of the best practices on what one should be doing on that in the subsequent slides. So that is the first thing. So once you have decided the stock universe and some of the basic things. So just to take a real example, let's say that I want to run my momentum strategy and create a portfolio on the stocks which trade in the futures. Correct? So that is 229 stocks right now. Then I want to create a portfolio of 20 stocks and I want to rebalance monthly. And based on certain conditions, I want to pause that strategy and move to another asset class if the market sentiment turns bearish. How do I decide bearish is another thing that we need to think about. But if it turns bearish, then we will exit and move to another asset class, gold or fixed income. So this is just an example. I'm not saying this is what you should be doing. And for that matter, whatever I'm saying in this video is not a recommendation. It is a learning for you. How do you create a momentum portfolio? So once you have decided on that, then the second thing is you need to filter the list. So again, as I mentioned, for filtering, we can look at a few criteria. We can apply certain fundamental criteria, technical criteria, and a few other data-driven things. So for example, one can also choose not to apply fundamentals. So it's a choice. But applying certain technical criteria and some of the other things are very important. Fundamental is in some way optional, because the whole premise is that the stock is doing well. Then at some level, the market has figured out that fundamentally it's a good stock and that is why they are doing well. But if you want to be doubly sure, or you have put little higher number of rules and your rebalance frequency is lower, or for that matter, you don't want to pause your strategy, you want to run even in the bearish market conditions, then the fundamental filters become very important. So I'll just take a very few examples on fundamental criteria. You can look at the valuation, which can be enterprise value to EBITDA, or it could be price earning ratio, whichever works for that for your strategy. You can look at that the company should be growing sales on quarter and year on year. It should be growing the profit year on year, quarter on quarter. The ROE and ROC should be at a reasonable level. If you are running your strategy on a small or mid cap, you may also like to look at the promoter holding, which says what kind of confidence promoter is having his own company. So these can be a set of fundamental criteria. Then you look at the technical criteria. Basically, in technical, you look at on the charts if they are doing well. So, for example, you can apply a simple moving average. You can say stock should be above 20 EMA or 50 EMA, and the 20 EMA should be higher than the 50 EMA. So you can apply that kind of criteria. There is not much difference whether you apply EMA or SMA, but eh, it depends on your comfort. I also say that on a weekly time frame, even though I do rebalance every month, I look at weekly super trend and I invest only in those stocks which are bullish on the weekly super trend. So that's the technical criteria that I apply. You can choose a set of technical criteria to apply. Then you also look at retracement from 52-week high, because these are momentum stocks and they should not have come down too much. This is not where you are trying to buy cheap and finding value. So a typical rule of thumb is 20 to 30% retracement from 52-week high. That's very logical. Of course, you can look at all-time high, but applying 52-week high and looking at 20 to 30%, maybe 30% retracement from 52-week high is a good thing. If you're using ETF, because they are much broader by themselves, you can look at even 50% retracement from the 52-week high. So that is the retracement. Then, very important, you should look at the relative strength. Now, the way you look at relative strength, for example, you are running this strategy on Nifty 500, then you would look at the stock which is on a 1 year relative strength doing better than the Nifty 500. I'm not getting into detail of what is relative strength, that you can see in some other video. But basically, either that or I plot a 200-day EMA of the relative strength, and the stock should be, in terms of relative strength, be higher than that moving average. So whatever it is, but essentially the universe should have higher relative strength. I mean, the stock should have the higher relative strength than the universe from where you are picking up the stock. One thing I heard recently from one of the experts, that he looks at the momentum. He looks at the momentum portfolio or the momentum index, which is Nifty momentum 50, Nifty 500, and then he compares against that. So it depends what you want to compare against, but I compare, because I do on the FNO, I compare against Nifty 500 and look at a higher relative strength. Then you can also put some filtering criteria around price or volume. For example, you can say that price should be above 100 rupees and less than 5,000 rupees or 10,000. For example, if you're putting only 1 lakh rupees in 10 stocks, you don't want to invest in a stock which is trading at more than 10,000 rupees, because that will not meet your requirement. So you can put some criteria like that. So basically, the step number 2 is that you apply a set of fundamental, technical, relative strength, retracement, price and volume related criteria, and shorten the stock universe that you want to invest in. That is step number 2. Now, the important step, which is after we have filtered, we need to rank order them and then decide on which stocks we are actually investing. So how do we look at ranking? The popular things based on which we rank could be absolute return. So this is the return, absolute return in percentage, not in rupee terms, but in percentage terms. Sharpe ratio or volatility adjusted return, which is return divided by standard deviation. But on what period? So when we are looking at percentage return, is it 3-month return, 6-month return, 9-month return, 1-month return? Typically, the strategy is run anywhere between 15 months to 3 months, not less than 3 months. That gives you not the right picture, not more than 15 months return. A very common thing is a 12-month returns or an average of 12 and 6-month return. So you can also do average. You look at the return over 12 months, 6 months, 9 months, 12 months, 6 months, 3 months. take an average. So I like running on just the 12-month return, but there are some other who propose that you should be running, taking an average of 6 months and 3 months, or taking an average of 3 months, 6 months, and 12 months. So once you have decided the criteria, absolute return in percentage, or Sharpe ratio, or volatility adjusted return, and then you need to decide what is the time frame. Based on these two, you rank order your filtered list. So from high to low. So high return to low return, I will rank order. So just to take an example, I'm running my strategy on FNO universe, which is 229 stocks. I apply a set of filter criteria. Assume that based on my filter criteria, I get 70 stocks which meet those filtering conditions. Then I rank order them on one of the above, let's say Sharpe ratio of 1 year. And so when I look at the Sharpe ratio of 1 year of all these 70 stocks, obviously something would have given the highest and something would have given the lowest. I rank from high to low. Once I have ranked them from high to low, then our step one was that we will invest in 10 stocks or 20 stocks. So assume that I'm investing in 20 stocks. I will select number 1 to number 20 and put in 5% of the money that I want to invest in this particular strategy equally in all these 20 stocks. If it was 10 stocks, I will put 10% in each of the 10 and I will select from number 1 to number 10. So this is how you do your first time when you're creating this portfolio and you're executing this strategy. This is the first time you go ahead and you create your portfolio. So once the portfolio is created, you have already invested, then you need to look at when do I rebalance and or when do I pause or exit this strategy. So in our step one, we decided whether we are going to rebalance every week or every month, because that's the more typical. 3 months is not so typical, and anything less than a week is also not very typical. Once we have decided, so what do I need to do on the rebalance day? What is the meaning of rebalance? Rebalance means I look at the portfolio and take a decision of either exiting a particular stock or buying something. Now, in this model, we exit completely. There is no partial exit. And whatever money we get, we invest that in the new stock. So how do we do it? On the day of the rebalance, assume that we are doing a monthly rebalance on first of the month. Then on the first of the month, again, I will look at my stock universe. So in my case, FNO universe, I will run my filtered conditions again, and then I will rank order them. So I will run step 2 and 3. Of course, 1 is constant. Step 2 and 3. And now I'm going to look at my existing stocks. And I'm giving an example of 20 stock portfolio. So I'm going to see that my existing holding, assume that I'm holding Paytm or I'm holding MCX. So I'm going to look at, are they in the top 20 or not? Now, this is where I can have two rules. One is that I look at them being in the top 20, and if not, I will exit, or I give them a buffer. So the original paper, which was written by Jagdishan and Titman, they kept a buffer of 100%, which means if I have a 20%, a 20 stock portfolio, then I am going to continue holding those stocks up to 40. So up to 40, I'm going to hold that stock up to 40 rank. But you can choose to keep till 20. So once you have done step 2 and 3, you will again have a ranked list. Assume that you have a 20 stock portfolio and your rule is that the stock has to be on the rebalance day in the top 40. So you are going to look at your existing holding and that particular stock, you are going to see, is it showing up in the top 40 or not? If yes, you don't take any action. If it has moved out of 40, you are going to exit that stock. That you are going to do for each of those 20 stocks. Each of them you are going to see, are they existing in the top 40 or not? Now, after you have done that, you found out that you had exited 3 stocks. 3 stocks from your existing portfolio are no longer in the top 40. So you will sell them. You will exit them. Then your portfolio will have only 17 stocks. So now you need to buy 3 new stocks. How do you decide to buy those 3 stocks? You will again going to look at your ranking, and whichever on the top which is not part of your portfolio. Let's say that number three is a stock, say SRF, and SRF is not in my existing portfolio, but now it is appearing on number three. Number one and two are two stocks which are already in my portfolio. Then that is one stock that I will buy. Similarly, you look at the list, and whichever is coming in the top three of the new rank order, which is not part of your portfolio, you are going to buy them. So you exited three stocks because they fell out of what 40 rank, because that was your rule. I mean, it was 2020. If they would have fallen out of that, you would have exited. So whatever was your rule, they've fallen out of that rank, you exited, and you had three space available. Now, when you exited, you will get some money. So whatever money you received, you are going to allocate equally in the three new stocks that you are buying. That's how you do it. In some cases, you also look at that a particular stock, if it is running, should not become more than certain percentage. For example, if you have a 20 stock portfolio, you can put a rule that a single stock cannot be above 12%. That is one way. The second thing some people do, uh, I don't know whether that makes sense or not, to be very honest. They will again, on the day of the rebalance, bring all the stocks back to the same ratio. So, for example, if it is a 20 stock portfolio, every stock should be 5%. On the rebalance day, they exited three stocks, brought back three stocks. But again, what they will do is they will make sure that whatever is now the new account value, every stock is 5%. I don't do that. I don't do that till it crosses a certain threshold. And in my case, I look at 12% if it is a 20 stock portfolio. So I hope you are able to understand it. If not, ask a question on the YouTube and I'll try my best to answer it. So this is how you do a regular rebalancing. Now, what happens if the market gets into a bearish phase? Because that's a very important piece in my view. And many people don't talk about that, particularly the ones who sell momentum strategy. Because if people start pausing, then probably their subscription, they will see not much value. But from my experience, I've seen that the strategy works very well when it is a when it is a bullish market or even a sideways to bullish market, but it starts underperforming significantly in a bear market. So, for example, from October till April, there was a very, very bad performance of pretty much all the momentum strategies. So you need to take a decision and you need to decide the criteria based on which you are going to get out of the strategy. So, so a few things there. For example, you decide that on the day of the rebalance, if the index, which is your universe, is below, say, 20 moving average, then I am going to exit that. The entire thing. I'll go. So there are a few decisions which are very important. Please listen to it very carefully over the next 2 minutes. So one is, what is the criteria? Okay. So I decided that the index on which I'm running. Now you can also use the momentum index, which is Nifty 50 momentum, sorry, Nifty 500 momentum 50 as a benchmark. If that is below 50-day EMA, I'm going to pause my strategy. So do I keep on looking at it every day? The answer is no. You don't keep on looking at every day. You decide the frequency on which you will look at and take this pause decision. I look at on my rebalance day. I don't, so my rebalance is first of the month. So I look at on first of the month if Nifty 500 is below 50 EMA or not. If it is below, I will exit. If it is not, I will continue. I don't look at every day because that saves me from the whipsaw. But some experts say that you should look at every week, if not every day. So even if it is a monthly rebalance, if it is a weekly rebalance, of course, you are going to look at every week. No doubt about it. So on the rebalance day, for sure, you need to look at your criteria. But do you look at more frequently? That is a decision point. The second decision point is, how do you exit? So when I'm saying I'm pausing the strategy, do I sell everything in that portfolio and get out? That is one way. The second way is that I will exit only those stocks which are giving me the exit signal based on the ranking criteria, but I will not buy new stocks. So, in the same example that I gave, the three stocks were exiting and three new were coming. Assume that we have to now pause. So, there are two ways you pause. The first is I exit the entire portfolio and move to another asset class. The second is I keep on exiting only the stocks which are falling out, which I had to exit anyway as per my rebalance. But in their place, I am not going to invest more. Okay. So this is the way you run the entire momentum uh, strategy. There are two tools that I like, and I'm going to talk about them. Maybe I'll make a video, but the owners of these tools themselves have pretty decent videos on the same. So the first one is by deifnedge securities. You can use something called Momentify, and Mr. Prashant Shah has very nice videos. You can learn from there. R zone Momentify combination. Now, if you heard from me and you learn and you are subscribing, I would just put a simple request that maybe use my referral code, which I will keep in the video description, and use that to open your deifnedge account. That's it. I don't have any other commercial relationship with them. The second one is momoindiascreener.in. So these are the two tools that I found very useful. Of course, deifnedge securities is much more comprehensive. Momoindiascreener.in also tells you how to do it. There are videos. Viraj is the guy who runs it. So you can watch these two, their video, Prashant Shah of deifnedge securities or Viraj of momoindiascreener.in, and use any of those two tools that you like to do it. You can, of course, create your own charting scanner and Google Sheet for ranking, that kind of things. I will see if I create a video if required. Tell me in the comments if you want me to create a video on these tools, and also a combination of charting and Google Sheet, Google Finance. Uh, Based on that, I will think whether to create one or not. So that's all I had to share. I hope you have understood what is momentum strategy, how you can do it yourself. And if you really liked it, then please subscribe to my channel. This is a humble request. And if you are using any of those tools, just give my referral. I don't think Momo India Screener has any referral. And once again, I don't have any commercial relationship with either of them. I don't even know them personally. But since I'd used them, I found them useful. Thank you so much. All of you have a great time.